Guys, the time has come. Finally, with low interest rates creating high demand and supply chain issues for builders reducing the amount of homes they are able to build in this market, home prices have gone from crazy to basically out of this world. Buyers are needing to put non-contingent offers 200 to 500,000 above asking price just to have a chance in this outrageous market. According to my last market update video, I mentioned that Matthew Gardner, chief economist for Windermere and one of the most accurate housing market statisticians and predictors I know, said interest rates would rise this year and that the 100-mile-per-hour home price appreciation would slow down to a more moderate pace. Now, in 2022, interest rates did rise fast, and we were seeing mortgage rates that were once 2.75% now in the fives. Why would this impact home prices? Because every 1% increase in interest rate is about a 10% reduction in buying power. To put this into an example, if you were to buy a $1 million house back then and you were to put 20% down, your payments would be $4,224. That same $1 million house today at 5.5% interest would be $5,500, which is a $1,276 a month difference for the same house. That's like a car payment for a Model Y Tesla. So does this mean the housing market will crash? No, not necessarily, but here's a likely scenario. One, we are likely to see an economic recession. Fed Chair Jerome Powell kept telling us the high inflation rate we've been seeing would be transitory. It has not been transitory. And I, like many others, didn't believe him. So they've pulled the lever hard to overcorrect on their mistake and raise the federal rates to slow down the rapid rate of inflation. Historically, every time we have done this, with Burns, Volcker, Greenspan, and now Powell, there has been an economic recession. So you may want to keep this in mind for your stock portfolio. What then will happen with mortgage rates and how will this affect the housing market? Well, if the feds stop buying mortgage-backed securities, which is the actual plan, and that it will roll out, interest rates will continue higher, and in my professional opinion, if rates stay 6% and under, most likely prices will slow down but remain upward. It's still historically very low. Now, if, however, it goes up 7% and maybe even 10% potentially, as you can see how much the monthly payments increase based off just a 2.75% increase, you'll likely see the market start trending downwards. What has happened every time there was an economic recession, the Fed tends to start buying mortgage-backed securities again, thus lowering the mortgage rates. So if you're frantically biting your teeth to sell your home before the market crashes, most likely it's not going to happen. It did happen in 2008, but that's only because we were giving out loans like candy to people who could not afford it. Okay, maybe you may lose 10, maybe 15% from your equity, but keep in mind, your equity doubled or even tripled if you held it long enough, and likely it will in the long run trend higher and higher. For those who are thinking about buying based off data and experts in the field, most likely prices will continue upwards, but slower. Even if it stagnates, interest rates will rise, which will increase your payments anyway. The saving grace is, even if you are paying the premium rates today, in 2 years, once the Fed lowers mortgage rates to fight the recession, you can always refinance back to the lower rate. Guys, I don't know where the market's going to go, but I hope this helps. This is the best interpretation based off the data that we've seen, the experts see. And so I hope this helps when you're making your real estate moves. And please share this with your friends and family, and I'll see you next time.